The impact of 7% inflation, which is to say a 3% negative interest rate, means that, if I'm right, we've only seen the first leg down in the bond market, but people are ignoring that. More importantly, however, is equity market breadth. The breadth in the equity market is all around the Magnificent Seven.
Prepare for an exhilarating ride as we sit down with Rick Rule, the dynamic founder of Rule Investment Media. In this gripping discussion, we'll uncover the thrilling risks and lucrative opportunities lurking in today's markets. Get ready to dive deep into the wild world of investment and speculation as Rick shares his expert insights on Fed policy and the tantalizing world of commodities.
We have not seen them need to counterfeit recently because the market for treasuries has been strong enough that they haven't needed to steal money. There is much more liquidity in the U.S. system than many people give them credit for. The discussion around the Fed right now, I think, involves around will they cut interest rates or will they not cut interest rates? It would appear, and I'm no economist, please, it would appear that the U.S. economy is strong enough that they don't need to cut interest rates. I think the Fed recognizes that there's no fiscal discipline in Congress, so the only entity in the United States that can fight inflation is the Fed. I think the Fed believes that the U.S. economy is strong enough that they don't need to cut interest rates. And unless or until there's another liquidity crisis, they don't need to do quantitative easing either. That could change on a dime. It could change on a dime. Remember that we could have a liquidity crisis in the United States that comes about from some fact, in which case the Fed would print like mad. I hope they shrink the balance sheet. I hope that they take their own holdings of securities and put them in the market, because I hope if we have a crisis again that they have the necessary firepower to deal with that crisis. So the idea that they can subtract liquidity from the market by shrinking their own balance sheet, I think is a very good thing to do. While I wish the Fed didn't exist, I think that the market for money and the market for interest should be free. I think that the market should set interest rates. I think that the citizenry of the United States should insist on a balanced federal budget. I don't think that we should rely on fraud and subterfuge to manage our economy. Having said that, I think the Fed has been unusually effective, given the fact that I disapprove of the job they have to do. I do, for two reasons. One, sentiment is even good around the bond market. The impact of 7% inflation, which is to say a 3% negative interest rate, means that, if I'm right, we've only seen the first leg down in the bond market, but people are ignoring that. More importantly, however, is equity market breadth. The breadth in the equity market is all around the Magnificent Seven. Wonderful companies, world-dominating companies, but you look at the strength in the S&P 500, it occurs in seven companies. It doesn't occur at 493 companies. So the cost of capital for 493 companies is high.
Yes.
The cost of capital for the seven is sub-zero. So I'm very concerned about the narrowness of the market. I am impressed with the real strength of the U.S. economy. We have more than doubled the U.S. interest rate, doubled the cost of capital, and in my community, there's a genuine labor shortage. They're paying young people $20 an hour to start at Safeway. This is an amazingly strong economy. I'm not as concerned about the economy as I am markets, which I think are currently delusional. If you're getting paid 4% in a piece of paper that pays you in a currency that's depreciating at 7% compounded, again, we're seeing bifurcation. Investment-grade companies that can sell paper into the 10-year market or the 15-year market have increasingly lower cost of capital. Mortals, however, companies that aren't investment-grade, mining companies that have to finance in the project market, their cost of capital is very high.
Right.
The cost of capital for companies around here, if they're lucky enough to get to the feasibility stage, the cost of debt capital is reading 15%, 16%. The prime interest rate is irrelevant to them because they can't access it.
For sure.
We're seeing now with credit card interest rates. I saw a credit card interest rate the other day. Bank interest rate for a consumer, 29%. People are borrowing revolving money at 29%. So when people talk about declining interest rates, they're talking about declining interest rates among the Fortune 500, among investment-grade companies. You aren't seeing declining interest rate and revolving consumer debt. I think the retail banking sector is over-levered. I don't think that 7% is actually a good number in terms of well-capitalized. I think that too many banks try to be too many things. The junior resource sector is really truly hated, and I think it's hated because it's underperformed for so many years. Let's look at the gold mining business just for a second as a proxy.
Yeah.
In the period 2000 to 2010, the gold price went up sevenfold. Okay, free cash flow per share among senior gold miners representing the Philadelphia Gold and Silver Stock Index fell. It takes real skill to generate lower free cash flow per share when the selling price of your commodity increases. My suspicion is at that period of time that they were given leave by the investors to grow. The investment attribute that they were asked to exhibit was leverage to the gold price, which is to say the investors asked them to be marginal, the lowest cost producer that has the most leverage. Well, if you ask somebody to be marginal, that's pretty easy to achieve. And the industry became so marginal that their cash flow per share fell. We've talked about the juniors, you and I, before. If you look at the length and breadth of the junior industry, there's probably 3,000 companies worldwide. I would suggest to you that 10 or 15% are viable. 85 or 90% are non-viable. So if you look at the performance of the sector, the entire sector, it will always be substandard because 85% of the population is substandard. You have to, as an investor, look through to the 10% of the companies that are viable. Those companies in a good market generate so much performance that they add legitimacy and sometimes luster to the 85% or 90% of the market that are comprised of the lame, the halt, and the blind. That's generous. That's generous. I think only 10% of the companies, maybe 15, have a chance to be successful. Many years ago, a young intern, that's financial services speak for slave, was working for me. And he pulled 25 then VSE companies, now TSXV companies at random. And he found, admittedly 25 is not a good statistical survey, nonetheless, he found that of the 25 companies he pulled, the median company spent 64% of capital raised on G&A. How is that sustainable? You're in a risky business where 35% of the money is invested in a risky business with the hope of generating a sustainable return. 65% of the money goes to lifestyle.
Hopefully, our conversation with Rick Rule has inspired you with his fascinating insights into market dynamics, Fed policy, and commodities. Remember, the thrill of the market awaits, so keep the excitement alive in your investment journey. Please share, like, and subscribe to our channel. Thanks for joining us, and until next time, happy investing.